So yesterday we talked about the significant drop in B&M, and as expected there was a lot of you guys wanting to see my opinion on that. The video did really well actually. But as well as the B&M drop yesterday, there was a ton of other news out there. We had the acquisition that DraftKings are rumoured to make to enter the contract market. We had inflation data. We had Mobico surging up. We had Kate Box drop a trading update as well. So I asked you guys on the B&M video yesterday, which news story do you want me to cover next? And the one that came out on top was to talk about Barratt Redrow and the drop after the trading update from Barratt Redrow. So today we're going to focus on that one because it is a stock I own and I do think it's actually a pretty good, interesting opportunity. Let me know in the comment section what you want me to talk about tomorrow, and the one that is the most popular one in the comment section as well. I will try and cover that for you guys. But yeah, yesterday we had a significant drop in Barratt Redrow. You can see here that the stock at the peak of it dropped around about 11-12%. Had a little bit of a rally up, but still pretty significantly down since that trading update. Now, I'll let you guys know, I read the update as well at 7 a.m. when it came out, and my instant reaction was, okay, it's okay. It's not like a brilliant update. We wasn't expecting anything brilliant because we haven't seen a major improvement in the UK housing market, but it's doing okay. I thought the stock would be about flat on the day, and like I said, once again, another update where I looked at the share price open up and I was like, what? How has this gone down 12%? You know, between looking at B&M yesterday and going, that doesn't make sense, and I had Barratt Redrow and I was like, that one doesn't make sense. A bit loads of confusion going on yesterday with some of these stock drops that were going on, and then Mobico was doing the opposite. That was surging up, but yeah, I was looking at this one and I was like, I don't know why the stock is down that much. It doesn't make sense to me. And today I'll kind of point out why I kind of feel like I didn't really get why the stock went down. As soon as I saw the stock drop 12% yesterday, I was buying the shares really early on. Yesterday was an expensive day. I was buying a lot of stocks yesterday on the UK side. So I did pick some of these shares up when they were down 12%. Obviously a little bit of a rally since, but it's still down a fair bit since it's close on Monday. If we just zoom out a little bit at the moment, you know, UK house builders, they went on a little bit of a rally through 2018, 2019, 2020. And then as we kind of peaked in 2021, as the world went mad, spending money on expensive things, and we peaked as interest rates started going up, and then we had a lot of these UK house builders fall significantly, you know, down plus 50%. And really since 2022, where we had that kind of mini budget situation, yeah, there's been a bit of a rally, but I mean, we're only up 10% during that time frame. But yeah, the signs of the recovery starting to happen are maybe there a little bit, and in my opinion will eventually happen because, you know, we just have such a natural undersupply of houses in the UK, and as well as that, as interest rate cuts do start happening, I think that will obviously start speeding up the process a little bit. And to be getting a UK house builder, you know, for half its value is normally a pretty attractive sign, a pretty good opportunity. So yeah, we'll kind of go through the update on Barratt Redrow. Just to start with Barratt Redrow, why do I like it? Well, and why would I say for me it's probably the best UK house builder? One of the reasons why is I think it's got an absolutely fantastic balance sheet. There's some good balance sheets in this house builder space, and Barratt Redrow is one of them. You've got 2.5% debt to equity, which is obviously super attractive, and the cash in hand is at 655 million, which at a 5.4 billion market cap is obviously really good. And even during this time frame, you know, the company is still producing okay levels of profitability, so they can still throw that into dividends, share buybacks. Also gives them, obviously, you know, they are still paying a dividend right now, which I think is around about 4%-ish. Yeah, about 4%-ish right now. But, you know, as we see the profit rise up, I would expect someone like a Barratt Redrow to start hiking up that dividend back up to 6, 7, 8% dividend yields as the profit does start recovering as well. The other reason why I like Barratt Redrow is I actually think I'm not a big fan of new houses. I don't really like new houses. But if I was to buy a new house, it would be Barratt Redrow. And whenever I go past the estates that they're building, I've got a couple near where I live, I always pass them and go, you know, they're all right. You know, you look at them, they've got a bit of character, a bit of personality, a little bit different. Compared to someone like a Persimmon site, I always go past Persimmon sites and I was like, it's like they copied that house and then they pasted it and then they pasted it and then they pasted it. And you have a street of like exactly the same houses. I feel like if you go through Barratt Redrow estate, you're like, yeah, they do kind of look a little bit similar, but there's something a little bit unique about them where they try to do some things a little bit different as well. And as well as that, the build quality as well tends to be a little bit better in Barratt Redrow houses. For example, I got this one up here which says about the UK house builders 10 highest rated for build qualities, and normally you don't see as many issues. Still some issues, don't get me wrong, but you don't see as many issues with a Barratt Redrow house, for example, 3.75 out of 5, and certainly once, sorry to use persimmon, but certainly there's less issues historically when you talk to people that bought Barratt houses compared to, persimmon houses. So, getting on to the results from Barratt Redrow anyway. So a couple of things to kind of point out here. So, one thing that did happen is the CFO did come in and buy some shares after the drop, which is obviously a pretty good sign. There has been a bit of insider activity as well. Previously, he bought a chunk as well on the 16th of April and on November, and then another independent directed buy. They are 20 grand chunks, which aren't like big amounts, but certainly, when you do look at these chunks, these free chunks that he's been buying, it's some confidence sign. It is a positive. Yeah, it's not a crazy amount, but it's a positive, that at least they're putting some money in, and when you do add them together, it does add up to a significant amount over a year. 60 grand is definitely not short change. Another thing that did happen is they did announce a share buyback program, which was around about 100 million as well, which obviously is a good sign that you're getting a dividend, they're buying back shares. If you ever want a company to announce a share buyback, that's them kind of going, hey, look, we think we're a little bit cheap here, so we're going to buy back a little bit of shares. And obviously, with the ability of balance sheet that they have, and the cash that they have, and the profit that they have the ability to do that, which is obviously a really good thing as well. There was a couple of changes in the management team as well, but nothing that was kind of like, well, that's a little bit worrying, so I'll also point that one out. Getting on to the update, though, a couple of things that I'll point out. So, against a challenging market backdrop, we have delivered a solid performance this year. So even they're like, hey, it was okay. And that's what I totally agree with. Like, I looked at this update today and I was like, that happened yesterday, sorry. And, I looked at the update and I was like, yeah, it was okay considering the environment. And that's why I don't get the drop. Like, if there was something like I was concerned about, I was like, yeah, okay, I can see that's a little bit concerning. But like I said, I walked away going, it was okay. I thought the stock would be okay today and yesterday, and the fact that it was down, I just couldn't see where this 12% drop came from. But yeah, so yeah, solid performance. Our adjusted profits are in line with market expectations. So there you go. As soon as you see profits in line, I'm like, it weren't that bad. Yeah. So yeah, profits in line with expectations. They did complete slightly below our guidance range, and I did post this on the Discord yesterday. I said, I don't know how much the market's going to say, oh, they're below the guided range, but I didn't think they'll punish them that much because the profits are in line, and that's the main thing. At the end of the day, compilations were a little bit behind. Yeah, okay, that could have been slightly better. But if you're still getting the profit that you're supposed to be doing, yeah, it's something that you would probably let go. I thought, okay, worst case scenario, the market throws its toys out plan, but yeah, your completions were a little bit behind, and your stock drops maybe 3-4%. When I saw 12% because of completions behind, I was like, come on, guys. The market being ridiculous. No wonder so many UK companies are leaving the UK markets. Completion. So they said it because there was in the London business. I've heard before in the UK housing builder space right now, a lot of the northern builders and northern projects are actually doing okay. It's a lot of the southern projects at the moment that are struggling in this space. So that does actually link up to what I've been hearing in the space, to be fair. They said that the benefits from the Redrow acquisition with cost synergies is being delivered ahead of schedule, so that's probably why they were able to deliver in the profits in line with the market expectations, even though the completions were below. And I looked at that as a major positive. I was like, okay, they've made this acquisition into buying Redrow, and they said, look, we think that if we buy this, it can save us a ton of money every year. And the fact they're going, hey, we told you we would save some money, and the fact it's ahead of expectations, I'm like, hey, that's proof. That's proof this big acquisition that they made is could be really beneficial for them. And like I said, the market threw it, but nah, whatever, we're throwing you under the bus because of it. And I was like, shouldn't we be rewarding it because they told us that we'd see synergies and we're getting it now? So yeah, it is what it is. So they said that Although demand for the year has demand during the year has been impacted by consumer caution and mortgage rates not falling as quickly as hoped, long-term undersupply of housing in this country will improve them. Totally agree. That's why I want to get a house builder at the moment. We remain confident in our medium-term ambitions of delivering 22,000 high-quality homes a year in the long term. And obviously, if they're hitting 22,000 a year, that would be obviously very good, because right now they are currently delivering, so financial 25 deliveries was 16,000. So that would be around about a 30% increase from where they are at right now. Obviously, as well, you'd hope that the house prices might be up a little bit since then. So you had 30,000 increase, or if that, if we do lazy maths and add another 30% to the current revenue that Barratt Redrow are doing, and that doesn't include the house increases. I mean, obviously this is just lazy math, so please don't take it too seriously. 6 billion in revenue, you add that on top to 7.8 billion in revenue, which is slightly higher than where they are forecasting for 2028. So maybe that's somewhere they're hitting 2029, or maybe even ahead of 2028 if there's a bit more of a recovery. And then you add, what profit margins can they make on that? You end up with, I don't know, 11% profit margins going down to that bottom line. You're around about what, 8 billion? 800 million in profit, and then all of a sudden you look, 708 million in profit is on a 5.4 billion market cap. It doesn't look too bad value. And then you think, okay, if they're able to go back up to 700 million in profit, what the ability they're going to have to throw that into increasing that dividend to what they used to be doing, the ability to once again add into the share buybacks. You can see why, if we're going to see some recovery, and if they do hit that medium-term target of 22,000 houses, you can see why this stock would go on to do well in the longer term. And that's personally for me why I do like Barratt Redrow. So they talked about the net private reservations did increase per week, as you can see here. Total home completions did increase as well from financial year 25. There was an increased adjusted item, you can see here, from 229 million from 2024 to 214 million. So maybe there was, which was related to the restructuring costs and acquisition related as well. So I don't know if, and the CMA as well, of 29 million. So I don't know if the market was a bit, once again, getting a bit short-term minded and thinking about the increased costs there, and we don't like that, and maybe that's what it is, but even then, that's stupid. These one-time costs, I don't know why you'd be throwing it out. It's the toys out of the pram because of that. They talked about the integration of Redrow and Barratt coming together. So you can see here, we have confirmed 69 million, good choice of number. So gotta be more mature than this on a proper video like this. Of cost synergies against our target of at least 100 million. Approximately 15 million of cost synergies are included in financial year 25 profits, with a further benefit of 45 million expected in financial year 26. So you can see, even if there's no increase in the profit next year, they're clearly saying that, with these synergies, we're going to hopefully see at least a 45 million increase of profit synergies next year, which at the moment, there is some forecast actually improving expected in the profit as well. So that's obviously something that's going to help them going forward. Now, in financial year 26, they said that reflecting current market conditions and revised expectations of a broadly flat average sales outlets, we anticipate total home completions in a range of 17,200 to 17,800, including 600 completions from our joint ventures. So you can see here, maybe the market was a bit upset, like there wasn't that much increase potentially next year. Maybe that's what they're getting upset by. But same again, it's slightly moving in the right direction once again. And obviously this is kind of like in the current market expectations. We don't really know. Things can change very dramatically in these next 12 months. And at some point, I would expect the housing market to, really start stepping up in the UK side. I know it's something that we kind of said that would happen last year. I know it's something that we kind of said this year, and something that might, happen next year. But yeah, ultimately, like we keep saying, like this will be the year it recovers, but it will. at some point the UK housing market will get stronger. There's no way that with the demand that's needed, and year by year we fall behind, that there'll be at some point a point where the market snaps and it will speed up again. So I am no doubt that UK house builders will have its day. It's just which one do you want to have? And like I said, I think when you look at Barratt Redrow, when you look at these cost savings that they have, the increase of demand that they're hoping to supply going forward, the balance sheet, the potential for the dividend, the profit that they'll be able to achieve, Barratt Redrow is the one for me when I do look at that point of view. So I do like it. Looking at the numbers going forward, P ratio wise, 2025 numbers around about 13 times earnings, which isn't ridiculous. 2026 numbers about 10 times earnings, which once again, nothing too bad there. And that's obviously not factoring, too much of a major boom yet. Obviously, I think they can probably achieve getting up to that kind of 7 billion, 8 billion in revenue. And then we'll see what Barratt Redrow trades at during that time frame, whether it be 10 times earnings, 11 times earnings, 12 times earnings, 13 times earnings. We'll see what the market puts it at as a valuation. It's always hard, I always feel like, to value exactly what a house builder what it will trade at. I know normally I'd show you some numbers, but a lot of people when you're trying to value a lot of these house builders, the traditional way that we try to do it off earnings sometimes works. But I know a lot of people would use the comparing the share price to net tangible assets per share. So if you would do that with Barratt Redrow, they are trading below the net tangible assets at the moment. So that's a sign that if you wanted to value it from that point of view, it is looking pretty cheap. I know some people like to value them off price to books because of the forms of the land banks they do have. So both of those are ways that you might look to value Barratt Redrow. It does look significantly cheap right now. If we were to do it off the traditional way, where I normally show you a valuation right now, taking a look at Barratt Redrow, I've put 4, 6, 8% revenue growth in here. I've put 8, 10, 12% profit margins in, which when we normally hit a normalish, betterish, I'm trying to think of a better word than that, market. So if we go back to like 2016 to 2020, that's even before like the CV boom. You can see here, like historically, 12% profit margins, 13% profit margins, 14% profit margins, 15% profit margins. So when I've been running my numbers on Barratt Redrow, I've put 8, 10, 12% profit margins in. So I've not even gone like crazy to where it was before COVID. I've put 12 times earnings in. I don't know if that's fair, maybe a little high. I've gone 12 times earnings. I can flick the numbers a little bit just to kind of show you guys here. And on the low side, you're getting 12%, but obviously that would be, 7%? The historic profit margins that they were doing previously before the CV situation. 4% growth wouldn't be much of a recovery. 12 times earnings. And you still make some money on this. Yeah, obviously you would be disappointed, but it's not terrible, is it? If you have 6% revenue growth, which is still way below where I think they'll be in that time frame, like I said to you, I think they'll be pushing up to about 8 billion by then, by 2030. 10% profit margins, 12 times earnings, you've got 50% upside. If you do believe they'll kind of get to that 8 billion mark there, 8% growth a year, 12% profit margins, which is getting a bit more to what they used to do before the CV situation. 12 times earnings, you get to a 95% upside, add the share buyback in, 99% upside. And like I said, the other thing as well that I think, a lot of people will be playing this for is that dividend. Obviously, as well, you add your dividend on top. So, right now it's a 4% dividend yield. Multiply that by 5 years, you're getting 20% off that dividend as well. So that 100% return, add 20% dividend yield on top, you're up to 120% return. But the other thing, like I said, is that when the profits do come back, I would expect them to go back to a dividend yield of 5, 6, 7, 8%. So if you're getting a 6% dividend yield a year, times that by 5, 30% return as well on top. So you add that on, you're up to 130% return. And overall, if you think they can drag the profit margins back up to a like a 14% profit margin, the upside does keep on increasing. If you think they can actually drag that revenue growth up to a 9% year, it just keeps going up. If you think they can get up to a 10% growth a year, so they're doing 8.7 billion in revenue, 14% profit margin, you're up to 150% upside, which is quite rare for a house builder, and one stock that you would say that a lot of people mostly get in for the dividend. You had the dividends on top. So, for a house builder, it's not often you see house builders where you're getting this like plus 100% return. Now, like I said, no one can predict the future, but I'm just showing you like if the numbers were to really execute, like that's why I like it. It's not often you have these points where you're getting those kind of big upsides on house builders, and obviously the access to probably a lovely dividend when things do go right. But even if we're not assuming like I said to you guys, I never like to assume like crazy numbers. And if we don't assume crazy numbers, there's still okay upside coming in here. But if they do really see a recovery in the housing market, and they do go back to numbers that they previously used to do, and we're not even talking like COVID numbers, like we're talking 2015, 2020 numbers, like, this does really well from here. And so, yeah, I like it. And as well as that, and, a lot of people ask me, like, why I picked Barratt Redrow over, plenty of other house builders out there. And that's been a reason why as well, a couple of reasons why today. So, yeah, I hope for you guys that wanted to see the Barratt Redrow video, hopefully that was useful. And like I said, let me know in the comment section what you want me to see, what you want me to do tomorrow, whether that be Mobico, Catebox, AMD, DraftKings, inflation data on the US, UK inflation data. That was a bit ugly today, wasn't it? UK inflation data on the UK side of it. I think Evolution are reporting their earnings tomorrow as well, so maybe it's Evolution. Let me know, and I'll cover that for you tomorrow. And then on Friday, I'm going to talk about a new stock I've started buying on the UK market. And then everything that I don't end up covering, well, whatever I don't end up covering tomorrow, I'll cover the rest on Patreon for you guys. So, yeah, hope you enjoyed the video, guys. Thanks for watching. If you're new around here, subscribe. See you in a bit.